The base metals complex is trading higher amid renewed optimism towards the US-Sino trade war after fresh tariffs dampened hopes of an imminent deal. However, my next guest says investors need to differentiate between the base metals affected by the trade war from those that are not. Daniel Lacalle is the chief economist at Tressis and joins us now. Daniel, good to see you as always. So which are the base metals then which are most sensitive to the trade war, would you say, and which are the ones that are often wrongly grouped into that category?
Thank you very much for having me. The base metals that are most at risk from the trade war are obviously copper and iron ore. If we look at the impact that it can have, this trade war, in the global economy, but also in capex decisions and in the Chinese slowdown, obviously iron ore and copper are those base metals that are most affected. Not just because of the impact on demand and the impact on the excess supply, but also because of the traditional activity of Chinese traders of increasing inventories and backing loans with copper, for example. So those two effects, both the weakening of demand and the impact of inventories and the impact of copper-backed or commodity-backed loans, those two factors are important, and definitely once we've had a rally like the one that we have seen in an environment in which global growth estimates have not been going up but rather going down, at least it would not be difficult to think that the best of the performance of these base metals is already behind us.
All right, let's have a quick look at the chart of iron ore, because we can see there's this clearly defined uptrend with higher highs and higher lows since the final quarter of last year. There seems to be some resistance up around 673, which had tested a couple of times in April. I mean, my question really is, do you think that was the peak, or do you think we continue to move higher?
I think if we look at the chart and we put it just together with, for example, the chart of global money supply growth, we will see that it's very similar and the correlation is very high. And we will also see that money supply growth stalled in April and has been coming down since then. Therefore, the money flow and the fund flow is an important factor. And if we look at the chart itself, what it's basically telling us is that there is a peak that is difficult to surpass. And that what we are likely to see in an environment of moderate growth, and even in an environment in which the trade dispute gets resolved somewhat, what we are likely to see is that it moves in this second trend that it has built since March, which is basically moving sideways in a very narrow range.
Switch on to copper now. Let's take a look at the chart of that base metal, because we can see that it had an impressive start to the year, obviously, but we have seen a considerable pullback since those April highs. We are actually getting closer to correction territory. So can you just give us a reminder of what's been driving that pullback and whether you see further headwinds to come, or could we be approaching the trough?
If we look at copper, I think that the key factor here is revisions, downward revisions of global growth. If we look at what happened, basically very similar to iron ore, it started to recover and recover quite strongly, robustly at the beginning of the year, driven by both money supply growth, low interest rates, and liquidity injections both in China and in Europe, and the expectations that we had the concerns about a global growth slowdown behind us. However, as April, May approached, what we saw was that very, very, very challenging peak and a very narrow range that it was almost impossible to surpass. And if you remember, we had this chat here together talking about how copper would likely have a bounce in the first quarter of the year and then return back to a weakening trend. And I think that that's where we are today. And I think that we're likely to test the lows We're likely to test the lows, and and obviously, if we go from global growth slowdown to recession, that would obviously take it to bear territory. I don't think we are in bear territory. I think we're just consolidating at a support level that is more in line with this moderate growth, slow growth, low inflation, and a low interest rates world that we live in.
Also, I wanted to get your view on nickel. This is another base metal I know our viewers are very interested in. I know this is one you're a bit more optimistic towards. Interestingly, last time we were talking, I remember zinc was your top pick. So yeah. Has nickel overtaken zinc? And tell us a bit about your investment case when it comes to nickel.
I like nickel here. Basically because there are a number of factors. The first one is supply demand. Supply demand is dynamics are much more robust and less driven by China than, for example, in iron ore and on copper. Therefore, you have a more diversified and a more robust strength in global demand growth. The other one is supply. I think that supply is tighter, and also you don't have in nickel the level of exposure to some of the industries that need very high capital intensity or that need very high levels of debt to continue to support the growth, in the typical construction. No? So oil and gas, for example, quite important for nickel, and oil and gas is coming back. The capex is coming back. So I think that here it can be interesting, but I like it more as a long to a pair. I like it more as a long to aluminium. I like it more as a long relative to, for example, copper, in which I think that the chart and the fundamentals are more challenging.
All right, and finally, let's talk about the dollar, because we can't talk about base metals without bringing up the greenback. We've seen the dollar basket gain by about 10% since the start of 2018, the start of last year. So do you think there's further strength ahead? And if so, will that continue to put pressure on the complex as a whole?
The good thing at least is that we saw the dollar strengthen and the base metal complex strengthen as well at the beginning of the year. And that was a good thing because it was driven by expectations of better macro in the United States and better macro in the rest of the world. However, the macroeconomic data that has been coming since then has been disappointing, to say the least. I think that, therefore, when we see the dollar strengthening, especially the last leg that we've seen of dollar strength, has been driven, unfortunately, by perception of increased risk in equities, in the markets, etc., and therefore looking for a safe haven in the dollar or in the US 10-year. I think that the dollar is very unlikely to go higher than the 97, 98 level that we have in the DXY index. So I don't think that is going to put further pressure on the complex. I think that the complex right now, what is reflecting is a more logical, I would say, environment of global growth, a more realistic environment of global growth, rather than the over-optimistic one that we saw at the beginning of the year.
All right, Daniel, thanks so much for your time.
Always a pleasure. Thank you very much.
See you soon. That was Daniel Lacalle, Chief Economist at Tressis. I'm Victoria Scholar, and thank you for watching IGTV.